Hey everybody, Jonathan Broadbent here, your host of UnWoke Academy. Welcome to another episode. Quick tip of the hat to our friends over at OBBM Network and BlessedNewsTV.com, our awesome distribution partners with expert guidance and help on all things tech, video, lighting, you name it. Both have been tremendously helpful in getting this show up and running off the ground and out to you, our fine friends. So I've got something I want to dive into today from an alert reader, brought this to my attention and was asking questions. But first, a comment on the 100-100 party. If you're following that, we're at 144 days, 10 hours, 46 minutes, and 45 seconds. This is actually a back-to-back. I just actually wrapped up recording a session focused on private membership associations. I hope you watch that one as well. And that relates to the countdown timer to 4th of July and our plan for independence. By the way, if any part of that is unclear, or you're just curious about the 100-100 party and what happens on the 4th of July, in addition to celebrating the autonomy and independence of the United States of America, go back a couple of episodes and watch the 100-100 party episode of UnWoke. But let's dive into this nefarious mess. So somebody brought to my attention an article that came out in, this is Investment News. I've heard of this, but I really don't know anything about this publication. But this publication brings up something that is fairly common in the world of finance. So how do I want to put this? I remember as a kid, there was like this phase we went through with banks, and banks used to offer freebie stuff. And it actually became kind of a cliche joke, the free toaster. If you're of a certain age, you'll remember at least the jokes about the free toaster you could get with opening a bank account. Well, I think people sort of quickly figured out that if you're banking somewhere and they're offering you some free toaster or a coffee maker or something, you know that they're making that money and then some off of you. So the chances are really good if you pay attention to what it is that you're giving up in exchange for that free coffee maker. You could probably buy yourself 5 coffee makers of similar quality all on your own. So banks would try to lure people in with little tchotchkes. And to an extent, they still sort of do. There are banks that hand out all kinds of little stuff. If it's a couple of bucks, then I think it's just marketing or whatever. But the whole idea of like luring you in, like, ooh, you can have a toaster now. That's just it seems, especially now, this since the 70s, toasters have become common. And I think that was a common thing in the 70s when toasters were kind of a new idea, or 60s, whatever years the toasters came out and they weren't a household item. My point in bringing that up is that still happens. It's just more nefarious and a little bit more hidden. So you'll get these financial firms that will offer quote unquote free stuff. Come on over to us and you can have free, and they'll like put it bold and have like sparks coming off of it and stuff, and it's big all caps and everything. You too can have free something, fill in the blank. Well, always follow the money, especially when you're talking about your money, and especially when you're talking about a financial firm. They're in it for the money. They create and actually pursue your money in order to make money off of your money. That's what financial organizations do. If that comes as a surprise to you, I would be surprised. But anyway, setting that aside, if you're lured into transacting with some sort of firm, like a stock trade app or something, it's like get 3 trades for free, or your first 5 will deposit $500 into your app or whatever. If you're the type of person who thinks, ooh, $500 for free, maybe think again, because those firms don't do that out of generosity. They're doing that knowing that that $500 comes back to them manyfold. So if they spend $500 to get your account, then the chances are probably pretty close to 100% that they're going to get back some multiple of that. And if you're giving them $1,500 or $2,000 or $9,000 or whatever in order to get that $500 deposit, is it really worth it? You need to be asking that question, because it seems like, kind of like with politics, we the people keep getting short shrift. We keep getting the short end of the deal, and that's where information comes in. So this particular article is talking about this sort of feud. There's a war between, I shouldn't say war, there's a battle between a bunch of these different financial services types of firms that all have these for-profit business models. I don't fault them for that, but they're fighting over their match percentages on IRA rollovers. Let me unpack that a little bit. So if you work for a while for a company, let's say that you work for 10 years for some company and they have a 401k plan or something like it, you can build up a pretty sizable chunk of money. That chunk of money is really tremendously desirable to companies out there. They want to add that to their roster of things that they're managing, because there are all kinds of ways that they can make money off of your money. That probably 100 ways at least. So capturing rollovers or attracting rollovers, I should say, is a big part of the financial world. And you've probably seen it. If you open up a financial services firm on your browser, go to any financial services firm, and you're likely to see something on the main page. Have an IRA rollover? Click here. Or if you walk into a bank branch, there's probably big placards that say, we do IRA rollovers. Whatever it is, just pay attention to what's being done in order to attract that money, because here's the deal. And I want to try and put this in the clearest terms possible. It was Albert Einstein, I believe, he's attributed with the expression, the single greatest power in the universe is the power of compound interest. So if you put some lump of money, just think quietly to yourself, don't say it out loud, just think about whatever sort of lump of money you may have saved up. Or just imagine what you think would be cool if you did have it saved up. It doesn't matter. Imagine putting that money into an investment account somewhere, and hopefully you get a good return on investment. You can't, really nobody, maybe outside of these nefarious, horrendous politicians in Washington, D.C., you can't control the return on that investment. It could be good, it could be not so good, it could be bad, and it's probably over time, it's going to be a little bit of all of the above. Sometimes it's down, sometimes it's up, etc., with the exception of politicians who always seem to manage to navigate their way to massive returns. I'll save that conversation for another time. But imagine whatever that return is, the only thing that you actually can control are the fees that you pay. So whatever sort of fees are coming out of your account, the more you can compress those fees, everything else being equal, you end up with more money. And over time, that more money compounds each year. So if you were to save, and I'm just using arbitrary numbers, but if you were to save $100 in fees every year, it's not like after 10 years, you have $1,000. You have way more than that, because if your account is growing, the $100 each year is growing and compounding, and more money on top of the more money adds each year. That's the power of compound interest. That's why Einstein said such a glowingly positive thing about the value of compound interest. So manage fees where you can. And if you agree with that, if you agree with the notion that you need to manage the fees wherever you can, then you are not the free toaster type. You are exactly the opposite. So these things, I'm not going to mention a whole bunch of these names, but I've heard of some of them. But these are financial firms out there. A lot of them are web based, so they have like really low overhead, low cost to operate. But two things about it. One is, and I'm going to get to UnWoke in a moment, but one piece is they want to lure you in order to profit off of your money. They're going to piggyback off of the profits of whatever your money is able to do. The second thing to know is whatever they're offering you, whatever the value of that is, if it's a toaster or $500 or $10,000, it doesn't matter. Whatever that is, just know that they're offering you that not because there's some sort of good and generous charitable group or person. It's because they expect to get way more than that back again. And overwhelmingly, that's what happens. They are successful at creating these formulas that allow them to offer something and then they get a huge return on investment. The more the return on investment, the more rich they get. And generally speaking, the less well you do. That's kind of the formula of these financial services types of firms. But it gets actually a little bit worse than that because we're in an environment right now where the big incentive is to manage money in very anti-American, anti-West sorts of ways. So we see huge inflows into the Chinese Communist Party. Actually, I should say it goes into China, but once it goes into China, it's really difficult for those of us who don't really, we can't from the outside view the delineation between China and the businesses in China and the Chinese Communist Party. So effectively, we sort of assume that there's a high degree of interaction and control that comes from the CCP or Chinese Communist Party that's exerted on those businesses. So we are actually diverting money out of the US and Western economies and into China, for instance. And of those companies that we're looking at that end up funded overwhelmingly, I believe, as we begin and continue to do more research into the investment modalities and philosophies behind these companies that are trying to lure in your big dollar deposits, the overwhelming majority of everything that we've looked at so far, when it gets big and mega, leans ex-US. By ex-US, I mean these are investment managers and financial firms that seem very myopic and they are focused. Actually, some of them are on record saying that they won't consider US investments. That's horrible. So let me put a little finer point on that. We're talking about the millions of US workers. And this isn't just a US problem, but I'm focused on the unwoke conversation, and that's my US audience. Wherever you are in the West, Canada or Mexico, or if you are in parts of Europe, wherever, the same thing holds true. You have these globalist managers who have figured out that by teasing you in and luring those dollars in your deposit account, things like your 401k for my American audience, when they lure those in, they have the normal amounts of control and they can squeeze profit out of that. And they've been doing it for decades and they're really, really good at it. But now also they can do horrible, nefarious things with where it gets invested. So it goes into far left, wokeadoodle companies, causes, and countries. None of that is good. So this is definitely one of those circumstances where we say free isn't free. It isn't the toaster or the few percent or a couple of trades or whatever, they impact to you, not only in terms of the cost and losing control and having opaque investments that oftentimes are really difficult for you to figure out. So let's touch on that for a brief moment. I get people that come to me with these statements, and they have a manager or a mutual fund or what's referred to as a sub account, or maybe it is a collective investment trust, or those kinds of things that can be really difficult, even for those of us who are financial professionals, to root out and figure out where that money is actually invested. So imagine your average investor who's busy and distracted and going about their regular, ordinary lives. Their money is being funneled into things that is, for the average layperson, virtually impossible to track down. It's really, really difficult for us, and I have tremendous tools at my disposal. The other piece of that, and I want to speak to your pocketbook for a moment. So everybody out there, when you invested, when you have that lump of money, whatever it is, and I hope it's great. I hope you have a big lump of money set aside and great savings, preparing you for a wonderful, relaxing and enjoyable retirement. Whatever that looks like, that's money that's hard earned, and you've worked hard to create it, and you care. Let's be honest, you care about the return on your investment. For a lot of people, that has led them to sort of a lethargy, like, well, those Wall Street firms, they probably know what they're doing, and they're probably going to be all right, and they'll do the right thing for me. But over the last 5 years, it's actually been the opposite of truth. Many of these Wall Street firms, as they have fallen hook, line, and sinker into the ESG thing, again, that stands for environmental, social, and governance. It's awful and manipulative. And as they've fallen into that trap, the investment performance has gone horribly wrong. They're actually doing very badly. Part of that, well, a few pieces to that, because it's kind of important that we pause and look at what's happening there and why. The first thing is, we've seen some very visible, very public ramifications for misbehavior on the part of corporations. So there are corporations that have been encouraged to do self-harm. These are companies that have been effectively told by the power brokers, the people that hold the money that those companies require and rely on. They've been told, and I'm sorry, I've got to say it because it's this visual that's been stuck in my head from the beginning. It's like the abusive older brother that pins you down and makes you hit yourself with your own hands. Like, why are you hitting yourself? Why are you hitting yourself? That's what happens with corporate equity index. That corporate equity index is a social credit score for corporations. And if your social credit score goes down, your profitability goes down, your access to money gets bad. You can have all kinds of problems because these mega conglomerate globalist families and corporations, and it really just is a few of these uber powerful billionaires, they can dictate, they can make companies do horrible things that they wouldn't otherwise do, that actually damages their brand. So the stock price goes down, and we've seen it. So we've watched things like Target, and I think, what was it, at one point it was reported $13 billion, somewhere around 13 billion in losses from the stock price, because people reacted to the bad choices that Target was making and putting all this, I call them the rainbow mafia, by putting LGBTQ plus into the children's and toddlers section and all that stuff. Parents don't want that. Anheuser-Busch bringing in Dylan Mulvaney as a cross-dressing representative of their firm. Bud Light is a typical blue-collar sort of beer. It's just counterintuitive, and it's just utter nonsense. But I personally believe that that is a byproduct of pressure from not just above, but over Anheuser-Busch and Target Company. They had to do that, I believe, in order to keep their corporate equity index score high in order to keep their profitability high. It's all bad stuff and it's all awful. But my point is, if many of these far left woke managers didn't have access to the many trillions of dollars of our investment monies, things like your 401k and the rollovers and all that stuff, I think that those stock prices would have gone down even more. So you see the product of that. Because remember, when you're buying a mutual fund, that mutual fund is invested in a whole bunch of different companies. And overwhelmingly, if you play hands off, I believe that most of the managers out there are just sort of being swept along in this current of far left ESG stuff. So hopefully this is all clear to you. What ends up happening is that reported, whatever it was, $13-ish billion loss from Target Company, it should have been probably a lot worse. It should have been more dramatic, but we had investment managers pumping money into Target stock at around the same time. And actually, we've seen examples where companies have done terrible things and might otherwise drop significantly, but they've sort of stayed flat, and everybody sort of scratches their heads and wonders why is this bad company has done a terrible thing, but the stock price stayed fairly level or just down a little bit. The reason for that is our money is being used in bad ways against us, and our money gets into the hands of some really bad actors because we let it fall there through just sort of not taking an active role in the administration of our 401k plan at a high level. We're talking about many billions of dollars. I'm pushing hard on that front. Individually, it all adds up. We have just one company alone, BlackRock, has $10 trillion in assets under management. That's money that they have collected from you. Excuse me, it's not assets under management. BlackRock manages, I want to be clear, BlackRock manages around $10 trillion, and that's your money. It's our money. It's 401k rollovers, etc. So that is a massive cost to that quote unquote free account, or fee waived for the first year, or first 10 trades for free, or we'll deposit $500 into your account or whatever. Don't fall for it. You're going to pay back way more than that. They're going to make profit in multiples off of whatever it is they offer you for free, and they're going to take your money and shove it into far left woke companies and causes. I'm Jonathan Broadbent. This has been another episode of UnWoke.academy.